You can proceed whenever you want. We are on YouTube, on live stream. Okay.
Thank you very much, and welcome to the 10th session of Accounting and Finance Research Congress. We have 5 presentations, and all are interesting, I must say. I will mention that one of our presenters will be a little bit late, so I changed the order of the presentation. Instead of I changed 4th and 5th presentation. Is it okay for you, Ibrahim?
That's okay, I'm fine.
Okay, no problem.
Yes, no problem.
Right, then let's start with Burcu. Burcu will present us the analysis of sustainability reporting and bank performance evidence from this sustainability index. Okay, we are listening to you, Burcu.
Okay, do you want any information related with me? Short stuff.
Yeah, please introduce yourself. Where are you from? Where are you joining? Which university are you?
Okay, my name is Burcu. I'm from Başkent University Commercial Science Faculty. My department is Finance and Banking. In the last 2 years, I'm working on corporate governance and sustainability. And today I prepared a related subject and an article here. And I'm sharing my presentation, so I can start with my presentation. My topic is analysis of the
meantime, Professor Nalan Akdoğan is here, so be careful. I suggest
yes.
Be very careful. Okay, go.
Analysis of the relationship between sustainability reporting and bank performance. First of all, I want to talk about sustainability reporting. In today's world, stakeholders want to know more about businesses. As you know that just financial results are not enough for stakeholders. They also want to non-financial operational results of businesses. So businesses all around the world started to prepare sustainability reports. In sustainability reports, they are presenting their environmental results, economic results, and also they are sharing information with 3 dimensions. These dimensions are environmental, social, and governance dimensions. I talk about stakeholders. First of all, I want to give more information about stakeholders. In today's world, stakeholders are management, customers, suppliers, creditors, community, government, shareholders, and also new generations, future generations, animals, spices, nature. So we are talking a very populous, very crowded stakeholders group. Firms are preparing sustainability reports for stakeholders to inform them about non-financial results. Also, firms want to get some benefits from these reports. Sustainability reports are increasing the reputation of businesses, increasing their positive image. And employee engagement, more productive firms. They can be more productive firms, better products, more sales, so they can increase their business performance also. So non-financial reporting also related with financial results. They are showing and they are presenting us in their sustainability reports economic results and environmental results. For example, they are presenting energy consumption, water consumption, their emissions, their waste policies, how they are recycling their wastes. And they are talking about human resource management. For example, they are telling us their turnover ratios in sustainability reports, work safety, applications, and what they are doing, the community, their social, how can I tell, social, their social, how can I tell?
Dimensions.
Their social projects to improve society's general situation. How do they use their new? How do they use new technologies? How do provide transparency? And another problem is anti-corruption, as you know. How do they? What do they doing against the anti-corruption? They are all generally telling in their sustainability reports. But there are some handicaps about this situation. Because in general, business management doesn't prefer to show negative issues in their sustainability reports. Business management prefer to hide activities. They do not want to include negativity in their sustainability reports. Another handicap is comparability. All around the world, sustainability reports are prepared by companies, but it's not easy to compare them. So, Global Reporting Initiative, GRE, has set standards to eliminate different practices. And the other aim is this standard is ensure the reports comparability. At the same time, some organizations like Bloomberg, ARIS, SAM, Dow Jones started to measure firms' sustainability performance, sustainability measures. These measurements provide the creation of ESG notes. ESG means is environmental, social, and governance notes. According to Weissman, ESG covers the environmental issues and corporate governance and CSR. So ESG notes are in today's world following by all stakeholders. I used Bloomberg ESG scores in the study. Bloomberg ESG scores have 120 indicators, and score range is from 0 to 100. And these indicators weights differs by industry. I mean, if we are talking about chemical industry, indicators are different for them. But if we are talking about transportation, indicators weights are different. So Bloomberg's ESG scores are good to compare firms in the same sector. The disclosure score indicates transparency of companies' environmental, social, and governance practices, and the non-financial performance of firms. It's believed that the preparation of sustainability reports can help companies to provide a competitive advantage and achieve better financial results. For whether the high ESG score to be obtained with detailed and carefully prepared reports affect the financial results of the business. So it's the main reason of what is attracting about this issue to the research. Researcher wants to see the relationship between ESG scores and financial results. In the study, I worked on ESG scores of banks included in the Borsa Istanbul Sustainability Index. And I also looked at their financial results. I used return on asset and return on equity ratios. When we look at the bank list, we can see that Akbank, Garanti Bankası, Halkbank, İş Bankası, TEB Türkiye Ekonomi Bankası, Vakıfbank and Yapı Kredi Bankası. There is one more bank, but it's not a deposit bank. As you know, Türk Sanayi ve Kalkınma Bankası is not a deposit bank, so I didn't use its data. I received the data set from Bloomberg Terminal. Before literature review, I want to tell about ratios that I used variables. I want to give more information about it. Return on assets, net income to total assets, return on equity, net income to total equity, NPA, non-performing assets. This is the used by financial institutions for loans. Non-performing assets means is credits that's given by a bank, but it's not paying on the time. So we are saying non-performing assets in banking, bank accounting. TL to TA, total loans to total asset ratio. I use them for control as control variables. I will tell more. When we look at the literature review, there is an important study. Fried, Bush, and Bassen prepared it. It's a meta-analysis, and they analyzed nearly 2,000 empirical studies, and they said that the majority of studies report positive findings. They mean SG, ESG, and financial performance is positively related. According to Cornet, Erjans, and Tehranian, largest US banks have higher CSR strengths and concerns. They also find that these largest banks appear to be rewarded for their social responsibility. It means return on assets and return on equity have positive significant relation with CSR scores. Wu and Shen, the data set was 162 banks from 22 countries. They also reported positive and significant relation between CSR and bank performance. Chi et al., their studies a little bit different others. They worked on 520 financial firms from 34 countries. And they said that firms with larger size and more CSR-minded and the financial performance and CSR are not related. Firms would actually act in more socially responsible ways to enhance their competitive advantage when the market competitiveness is more intense. As you see that they are added some other new variables in their models. Financial firms in countries with stronger levels of legal enforcement tend to engage in more CSR activities. However, interestingly and rather strikingly, those firms in countries with stronger shareholders' rights tend to engage in less CSR activities. And finally, self-regulation within the financial industry has a significantly positive effect on CSR, with firms being found to act in more socially responsible ways in those countries which have more comparative employer-employee relations, higher quality management tools, and a better macroeconomic environment. So, Chi et al. Looked at general economic conditions, and they classified the financial firms as how do their position in this economy. Bolay et al. Newly prepared an article, and they worked on 882 banks, and they worked on developed and developing countries banks, and demonstrate that ESG improves banks' accounting and market-based performance in developed countries. And they also said that ESG weakens the performance in developing countries. When we look at the Turkish literature, Sakarya et al. Prepared an article, Corporate Social Responsibility Explanations Effect on Business Financial Performance. They study on the BIST 30 components, these 30 firms, but their study is not directly related with ESG scores. HR prepared another article, a multi-criteria approach towards assessing corporate sustainability performances of privately owned banks. He just worked on performance, sustainability performance, not related with financial results. So there is no article related with the bank's ESG scores and bank performance relations for Turkish banks. My hypothesis, in order to investigate the relationship between bank ESG score and performance, my hypothesis is written below, has been tested. That's tested by me. ESG score is positively related with Turkish banks' performance. As you know, I used some variables, return on asset and return on equity. These are performance variables in my model. These are dependent variables. ESG, environmental, social, and governance scores. As you know, I received them from Bloomberg database. ESG is independent variable. I also used control variables. Because I want to control the features originating from banks. So natural logarithm of total assets, total loans to total assets, and also natural logarithm of non-performing assets are control variables. If you want to see my models, you can see here. I used ROE and ROE, and as you see, we have two models. When we look at the descriptive statistics, you can see that mean, median, maximum, minimum, and standard deviations are on the table, and they are similar in each country. So I couldn't see any very high or very low points. I also looked every variable's unit row test because variables are stationary or not, it's important for us. And I saw that all variables are stationary. I prepared correlation table also. As you see that high correlation ratios just for ROE and ROE, but they are dependent variables of us, so it's not problem for the analysis. And lastly, I analyzed I made regression analysis for these models. I used EViews program and also used ordinary least squares method. R squares are high, as you see that. For ROA model, R square is more than 50%, as you see that. But what I want to see is ESG score and ROA relation. ESG scores probability for ROA model is not good, not acceptable. So for the relationship between ESG and ROA, we cannot say significantly positive or negative relations. So we cannot say any relation for ESG and return on equity. When we look at the ESG and ROE, its R square value is nearly 50%. F probability shows that model is significant. But when we look at the ESG and ROE relations, and I cannot say positive or negative significant relations. So H1 hypothesis is rejected. For deposit banks, Turkish deposit banks, components of Borsa Istanbul Sustainability Index, there is no significant relationship between ESG scores and bank performance. And I also wants to give some clue for researchers who wants to work on ESG scores. They can look ESG scores and market performance relations for Turkish banks, or they can look the relationship between ESG scores and risk measures. Thank you for your attention and patience. That's all. I can take your questions.
Okay, thank you, Burcu, your interesting presentation. Now I would like to ask all the participants whether you have any questions or not. You can write on chat section or question and ask section. Which one do you prefer? While you are thinking, I would like to contribute to Burcu to improve this paper that I guess this result is different from other literature studies, and you should think about why our bank's performance is not positively related with sustainability reports. Okay.
There are some other studies in the literature, and they are in the same way my results. And as you see that in literature, I told about Boalai's article, and Boalai saying that ESG weakens the performance in developing countries. I think country-specific positions, situations are affecting the ESG scores. I want to prepare this study as an whole article, and I will inform more about literature review. And as you can see that there are some other studies that shows that ESG scores are not related with
okay.
performance.
Thank you. Any question? Welcome to our session. Dear Nalan hocam diyeceğim artık. I remember last year's Accounting and Finance Conference, there was a paper presented by Nalan Akdoğan's student. You can check. Is that you?
No.
Okay.
I'm a student of Nalan Akdoğan, but we didn't work on this issue.
Okay. Any question? Okay. So we move to the second presentation, which will be presented by Ibrahim Dendom Yakubi. Is that right, Ibrahim?
Yes, please.
Before starting, can you introduce yourself? Where are you joining from? Are you in Ghana or in Turkey?
Yes, well, I'm in Turkey here.
In Turkey, okay.
Yes.
Where are you now? What are you doing?
I am a PhD student in the Department of Banking and Finance in Ankara Yıldırım Beyazıt University.
Okay.
Yes.
Okay.
Okay,
Go, you can go on then.
All right. All right. Is my screen clear?
No, it's good. No problem.
Okay. All right. As I said earlier, my name is Ibrahim Dendom Yakubi, a PhD student at the Department of Banking and Finance in Ankara Yıldırım Beyazıt University. My second co-author is Dr. Al-Hassan Bunyamin. He's a lecturer in the Department of Banking and Finance in University of Professional Studies, Accra in Ghana. And Abdullah Ilyasu is a master student in Marmara University, Department of Islamic Economics and Finance. Our topic is on capital adequacy ratio, corruption and risk-taking behavior of Ghanaian banks. So we go through the introduction as well as the literature review, the methodology and the findings of the study. So we begin with the introduction. As we all know, we are familiar with banks and banking system. Banks play a critical, important role in channeling scarce resources from savers to investors in all economies, both developing and emerging economies, both developed in emerging economies. And the efficiency and stability of these banks or the banking sector in general is regarded as having a first order impact on economic growth, especially in less developed economies where bank-based system is the main booster for the economy. The crisis witnessed in the last decade, particularly the recent global financial crisis in the 2007-2008, has promoted a flourishing literature suggesting that banks' excessive risk-taking is a leading reason for subsequent financial turmoil. That is, excessive risk-taking of banks can lead to subsequent financial crisis. In the literature, the extent to which banks are susceptible to risk is found to be associated with a variety of factors. Bank regulation has been regarded as one of the important or the prominent factors influencing the risk-taking behavior of banks. In response to the global financial crisis of 2007, 2008, or 2009, let's say, which extent risk-based capital requirement has been reinforced in the new Basel III Accord to counter excessive bank risk-taking behavior. However, prior theoretical as well as empirical research that investigate the impact of risk-based capital requirements on risk-taking behavior is inconclusive as the findings vary. While some studies have shown that capital requirement positively influence risk-taking, others evidence otherwise. That is, they evidence a negative relationship between risk-based capital or capital regulatory requirements and risk-taking behavior of banks. The primary purpose of this paper is to contribute to the limited studies and the ongoing debate on the capital regulatory and risk-taking relationship in the context of Ghana. The second objective of this study is that we examine how corruption influences the risk-taking behavior of banks. And corruption in most developing countries currently is considered as one of the key factors influencing different phases of the economy. So we seek to investigate how it affects or how it influences banks to take on risks. In general, the role of corruption plays in financial intermediation is limited in the literature. On one side, corruption may hinder the increase of lending by raising the cost of loans, but on the other side, firms with higher productivity and efficiency can beat higher bribes and are more likely to receive loans from financial institutions. So far, prior research only provides some mixed findings on the financial outcome of corruption. For example, Kawaja and Main 2005 find that political connected firms get more loans from banks, but end up with higher default rate. Chabulated itself documents that firms with connection to politicians have better access to long-term bank loans and need less collateral, hence posing more risk to banks. But the researchers' knowledge, there is no empirical study in the context of Ghana which has examined the impact of capital adequacy requirement and corruption on bank risk-taking behavior. Hence, we present a first attempt or a pioneering attempt in this context and contribute to the limited studies on the determinants of bank risk-taking behavior. So we move to the literature review. So this theoretically, the relationship between bank capital and risk is ambiguous. That is, it has not well been established. According to that, there are three main streams of bank theory which relates to bank capital risk and a bank's regulatory requirement and capital risk. So, according to the regulatory hypothesis, the level of bank capital is positively related to bank's risk. Under this hypothesis, banks are encouraged by regulators to accumulate their capital with an amount of investment in risky assets. Nevertheless, the moral hazard hypothesis, which counterattacks the regulatory hypothesis, explains a negative relationship between bank capital and the level of risk taken by banks. According to this hypothesis, banks may have benefits to explore the existing flood deposit insurance schemes, and thus their level of risk declines with optimal capital accumulation. Empirically, the existing literature that examines the impact of minimum capital requirements on risk-taking behavior of commercial banks is largely divided. As I said earlier on, some studies evidence evidenced a positive relationship, whilst others evidenced a negative relationship. So some studies suggest that higher capital requirements encourage banks to take on risks. Empirical studies such as Altenbusch et al. 2007, Chim 2010, Lee and Hatch 2013, Rashid and Khalid established a positive association between capital adequacy and risk-taking behavior of banks. However, a second strand of studies suggests that higher regulatory capital requirements result in lower bank risk-taking. For example, these studies, as listed here, evidence a negative relationship between bank capital and risk-taking. For the impact of corruption on bank risk-taking, the literature is somehow deficient. The literature is somehow silent on this relationship, as few studies have considered the nexus between capital requirements and risk-taking behavior. From the scanty attempts, Detroit et al. 2008 and Will 2011 found that the group of lending decreases with more severe corruption. FAC 2012 noted that non-performing loans, a measure of bank risk, increases in countries where corruption is higher. Also, Chen et al. 2013 established that bribes enables more productive firms to be granted larger loans, which increases banks' risk level. Now, let's look at our methodology. We look at the sources of data as well as the variables employed in the study. The study employs annual bank level data of 11 banks covering the period 2008 to 2017, which is obtained from the audited financial statements of the sample banks. The perceived corruption index, which we have obtained externally, has been taken from the Transparency International reports. And we look at the description of our variables. Our main dependent variable, which is bank risk, which we measured according to the literature or based on literature, which we measured by bank Z score, which is defined as bank capitalization and returns divided by return volatility. And our main independent variables include capital adequacy ratio and corruption, and we control for the effect of bank size on these independent variables. So now we look at our estimation technique and our model specification and our estimation technique. As this study takes a panel approach that involves pooling observation on a cross-section of units over several periods. So therefore, our panel approach or our panel model is stated as this, where Y is the dependent variable, then X represent the independent factors, and E is the error term. And a major problem with, or which is inherent in panel analysis, is the problem of indigeneity. And the study, therefore, we try to minimize or to control for this indigeneity problem by employing the generalized method of moments techniques by Aruna and Bond. And with this, our model is very expanded as this, where Y is the main dependent variable, and Y like 1 means that we try to also examine if the dependent factor has a self-reinforcing effect, and X is already defined, and this represents the unknown term of, and A is the error term. So now we look at our results. We have presented our results, which is based on the two-step system GMM estimates. And we realize that this is which our main dependent variable. It has a positive and significant impact on current risk. So this risk like 1 means the previous risk level has a self-reinforcing effect on the previous risk level has a positive significant effect on the current risk level of banks. And capital adequacy also shows a positive significant effect. Corruption also has a positive and significant effect on bank capital, on bank risk-taking behavior. We evidence a negative and insignificant impact of bank size on risk. So now we discussed our results. Sorry, I have omitted this. I think from my analysis, I have copied this table. This has is supposed to be a significant impact based on my analysis. So we discussed our findings As we have seen, the analysis found that the estimated coefficient of capital adequacy is positive and statistically significant. This suggested a positive association between capital level and risk. The findings suggest that highly capitalized banks may invest more in risky assets to gain higher returns. And high level of capital encourages banks to invest in assets without diligent scrutinizing. Therefore, this can result in formation of risky portfolios. The significant positive impacts of capital adequacy on risk is consistent with previous studies as we have looked at in the literature review. In line with the findings of Park and Chen et al., we established that corruption exerts a positive significant effect on risk-taking, implying that banks' risk-taking increases with more severe level of corruption. This suggests that in a high perceived corruption environment, as in the case of Ghana, banks tend to, as in the case of Ghana and other developing countries, banks tend to advance more credit to unqualified applicants or customers with lower credit worthiness who are likely to default, and thus increasing the level of bank risk. We also note that our bank size, that is our control factor, shows a negative significant impact on banks' risk-taking behavior. This finding conforms to the result of Rashid and Khalid. The negative effect of bank size on risk implies that larger banks are less risky as compared to smaller banks. This finding also indicates that due to more expertise and economies of scale, larger banks may be able to construct more diversified portfolios and minimize or manage their risks more efficiently than smaller banks. We move to our conclusion and policy recommendations. We conclude that increasing bank capital has a significant and positive effect on bank risk-taking. This result suggests that banks are likely to invest more in risky assets when they have more capital than the regulatory requirements. The finding is in accordance with the regulatory hypothesis as we have looked at in the literature review, which suggests that higher levels of capital are positively and significantly related to risk-taking. The perceived level of corruption also drives the risk-taking behavior of banks, which support the grease-the-wheel hypothesis of corruption. And the grease-the-wheel hypothesis, it implies that, or it postulates that corruption in every sphere of activity tries to stimulate what it intends to. Our results present relevant policy implications for regulators and bank managers. In particular, the findings will help regulatory authorities to put in place stringent measures for improving efficiency and asset quality of banks in Ghana. This study may also provide useful guidelines to bank managers to maintain an adequate level of bank capital and construct well-diversified portfolios while making investments in risky assets. For customers as well as investors who are trying to pay or who make an intention to invest or deposit in banks, the findings may help them in selecting suitable banks for borrowing and investing activities, taking into account their risk-taking behavior. And to mitigate corruption, it is important for banks. We recommend that it's important for bank managers to outline corruption policies, control, to deter officials from engaging in corruption-related activities. For example, they can instill the whistleblowing policy, which is pertinent in controlling corruption. Thank you.
Okay, thank you, Ibrahim, for your nice presentation. Any questions from participants? Okay, you can now call Vildan then. Vildan, you are here. Evrim,
Yes.
which one do you use, Evrim or Vildan?
Evrim, thank you very much.
Vildan will present us the impact of COVID-19 on accounting and auditing, literature review. As an accounting professor, I will hear it more interested. Okay, let's hear you.
I want to introduce myself firstly. I am an assistant professor at Trakya University, Uzunköprü School of Applied Sciences. Now I want to share my screen. Can you see the presentation?
Yes, we can see, but can you change to full screen, please?
Can't you read it?
Okay, go on, go on.
Is it okay now?
Ah, right. Good.
Subject the impact of COVID-19 on accounting and auditing literature, but there has been few studies about on these subjects because seeing the impacts of it will take more time to get available data also. As you know, the coronavirus disease called as the COVID-19 is a new disease which was reported in Wuhan City, China in December 2019. And it is thought that the outbreak was spread from a market in Wuhan City, and the market was closed on 1st of January 2020. Now the cases and the death toll are on rise day by day. Now, by cases all around the world have exceed 40 million people, and the deaths have already reached 1 million. As the COVID-19 caused many deaths, many countries have had to take strict measures. Besides its effects on public health, the COVID-19 has triggered an economic crisis, and this economic crisis also has affected many sectors, such as airlines, hotels, travel agents, restaurants, automotive, because of the diminishing demand. Companies sooner or later will have to face the consequences of the COVID-19. Their operations also have been affected by the outbreak. It also has had some impacts on accounting and auditing procedures as well. The outbreak has put enormous pressure on auditors and accountants. Reporting in an uncertain environment is a big issue for accountants because they should reflect the uncertainty in the financial reports. Auditors have been trying to find alternative ways to collect audit evidence and complete the engagement because the auditors have problems, especially in physically in-person evidence collection procedures, including inventory observations, document collection, property and plant and equipment assessment. When we looked studies on accounting, the impact of the COVID-19 on accounting, they focus mainly on accounting education because universities have had to shift to online education and have still been experiencing many problems emerging from technical constraints. Some universities which couldn't provide their students with online classes have given open access to course materials. Some studies also reveal the accounting educators' adoption to distance education. One of the issues caused by the pandemic in financial reporting is the issue of estimates, such as valuation of receivables, inventories, or impairment losses. Owing to the higher level of uncertainty, the estimates will be less reliable and be intrinsically difficult. They will be difficult in nature. Companies need to disclose material uncertainties related to the events that may cause significant doubt on their ability to continue. as I mean going concern. When management assesses the company's ability to continue, it will need to consider the current economic uncertainty and market volatility. The literature review on auditing and accounting. Demer discusses the probable influences of the COVID-19 outbreak on financial reporting and auditing procedures that have created an unpredictable environment. The study points out some IFRSs, such as financial instruments, inventories, income taxes, and impairment losses, such as. The author also addresses some issues relating to auditing procedures, including assessment of material misstatement, audit evidence, accounting estimates, and continuity of business as a going concern. Karakaya also discusses the relationship between going concern, the continuity of business, and auditing. The COVID-19 has had a negative effect on companies that have suspended their operations, and the companies that cannot continue their operations have been on the edge of bankruptcy. The author also discusses the issues in going concern and evaluates the roles of both business and management and auditors to ensure going concern. The author thinks that auditors have a significant role in going concern that is under threat by the outbreak. Başkan addresses the importance of going concern during the COVID-19 disease. Pandemic, sorry. The study discusses how audit reports reflect the issues regarding going concern. Adana and Özbilecik have reviewed the potential effects of the COVID-19 on the audit process, including acceptance of audit engagements, audit plan and risk assessment, audit evidence, continuity of business, and key audit matters. They also explored the disclosures on the COVID-19 in audit reports and whether they are explained in accordance with what international standards on auditing require. Köse and Aldeniz have investigated audit reports of companies in Borsa Istanbul on the basis of going concern. They conclude that absent or insufficient disclosures in financial statements would result in inadequate and inappropriate audit evidence from material accounts, and not defining or not explaining the consequences of the outbreak on the financial statements completely. Albitar et al. Discussed the importance of digitalization in auditing. They see it very important during the crisis like COVID-19. They suggest audit firms should invest more in digital programs such as artificial intelligence, network security, because working at home is becoming prevalent day by day. They also specify that social distancing may substantially affect audit fees, audit procedures, and audit personnel salaries that may have strong effects on audit quality in the end. Maria and Victoria have aimed to determine the importance of digitalization. They also studied on digitalization in auditing. They state that in spite of having difficulties due to the COVID-19, audit work should be performed fully, and that technology enables auditors to do the sound work. They also add that the utilization of technology in audit would lead to changes in existing methods, planning procedures, the documentation process, and the assessment of audit risk and maturity, so on. Bircan emphasizes the importance of agile auditing during a crisis and uncertainty. This study suggests the audit firms to be, I think, flexible for the crisis like COVID-19. During the COVID-19 outbreak, which has caused uncertainty for companies, auditors should reassess the continuity of companies and extraordinary changes that affect financial statements, suggesting that auditing procedures need to be transformed in accordance with the changing situations. The study also underlines that agile auditing has a remarkable role in overcoming the negative consequences of crisis and uncertainty. Law and Malsh have explored auditors' responses to unexpected and systematic changes in circumstances during substantive procedures with the COVID-19 outbreak, a critical incident that disrupted all year-end audits in China based on 24 semester structured interviews. They had described the negative effects of the COVID-19 on formal and informal aspects of the audit. They conclude that in response to disruptions, auditors have had to improvise to maintain quality and ensure timely audits. They contribute the literature by introducing the term improvisation. John presents the reflections of now we are. I will show the studies on accounting education, the impacts of the COVID-19 on accounting education. John presents the reflections of the COVID-19 on higher education. In Turkey, face-to-face education has been suspended and open and distance learning methods have been used by students. The author states that many open access course materials are printed resources and the content and the design of the material are not interactive. The study also indicates that universities are not well prepared for distance education. Kurnaz and Serçemeli have investigated the views of accounting academicians on the basis of distance education. They state that faculty members have been experiencing some technical problems and that distance education cannot provide interaction between students and instructors because they are used to, many of the faculty members are used to traditional methods. Serçemeli and Kurnaz also have investigated the views of accounting students on the basis of distance education. The results show that the students didn't have any problems in terms of self-efficacy regarding the use of the system, but they didn't adopt the distance education. The study states that video recordings and flexible training opportunities had positive effects. However, issues with reaching internet and having socially isolated were negative aspects of distance education. Berkman aims to explore the way the COVID-19 has affected the teaching of management accounting and related research. The author finds that the textbooks, because of the lack of integration among management accounting techniques, do not have students learn to make quick changes.
I am sorry to interrupt, Evrim. Can you summarize, please? You have
okay.
One more time.
Okay. Conclusions. The COVID-19 pandemic has caused many difficulties for companies. Companies in any sectors have suffered from economic consequences of the outbreak. According to ICAFR', financial statements should be prepared fairly. which requires the faithful presentation of the effects of the transactions and conditions in accordance with the definitions and recognition criteria for the components of financial statements. Hence, accountants should prepare financial statements in accordance with the reflections of the COVID-19. Reflecting the COVID-19 outbreak impacts on financial statements has been more challenging for accountants than before. Although many authorities have issued some guidance concerning the results of the COVID-19 on financial reporting, it is still a problem to prepare financial statements fairly. Most auditors have problems with the audit process as they have had to stay at home and have experienced some problems with completing the audit work in time. They have had difficulties with collecting audit evidence as well. There are many problems from the standpoint of both instructors and students. The problems are mostly related to technical constraints and instructors who seem to fail to adopt new teaching techniques. Therefore, accounting education needs to be more flexible to respond to unexpected crises. This study aims to explore the studies which focus on the effects of the COVID-19 on both auditing and accounting. The literature reveals that there seems to be a scarcity of research on the topic. The study is focusing on the preparation of financial statements, continuity of bills. I want to conclude that accounting education and auditing procedures should be shifted and comply with the new technical procedures. Thank you very much.
Thank you for your nice presentation. I will ask again any questions about this presentation or contribution you would like to make.
Can I say something about this?
Please, Burcu, proceed, okay?
I think the main point is digitalization, because COVID-19 directly speed up the digitalization level in every, how can I say, in every area, auditing, education, accounting education. I think we underline the digitalization on it. So we can maybe add some new issues about CAT's applications. CAT is computer-assisted auditing techniques. So we can give a little bit information about these applications, maybe.
Thank you very much.
And I'd like to say something about your presentation, just to improve as a contribution, if you accept. I think you should classify your review by time, by country. It might be by concept, by subject, whichever you prefer. That will be more understandable and will be useful. I think. Okay, good study. Thank you very much. I think there is no other question. I cannot see from chat or question and ask. However, in chat section, Professor Nalan Akdoğan gives some information about sustainability reporting. You can look at, especially Burcu. You should see that.
Yes, I saw it.
Contribution. Okay. Then let's move to the fourth presentation, and we are going back to Ibrahim again. Ibrahim, are you there?
Yes, I am there.
Okay. You can start your second presentation.
Okay.
Evrim, can you close your presentation? Yeah. Right. Okay.
Evrim, escape them.
Okay.
Tamam. Okay.
Thank you.
I hope you can see the screen. Okay. Is my screen visible?
Yes, yes. Please go.
Thank you. Okay. All right. The second presentation is on the relationship or the nexus between economic freedom and performance, bank performance in Ghana. And this one is solely presented by me. We'll begin with our introduction. The significance of banks is reflected in the fact that they serve as the primary channel of deposits and credit allocation in the economy, as posited by Levene. The banking sector also plays an important economic role in providing financial intermediation and also stimulate the economy by transforming deposits into viable investment. The financial system and the economy as a whole are therefore severely impacted by the performance of the banking sector. Undoubtedly, a stable and efficient banking sector is best equipped to deal with adverse shocks and to add to the resilience of the financial system. Given this, the determinants of bank profits have drawn the attention of researchers as well as bank management and regulators over the years. The recent literature has illustrated that the profitability of banks in both developed and emerging economies is heavily influenced by bank-related factors, market or industry indicators, and the macroeconomic environment of countries. Nevertheless, an important relationship or link that has not been given adequate attention or that has been given little attention in the literature is how economic freedom affects the profitability of banks. Evidently, according to ICAFR', several studies have shown that economic growth is significantly influenced by financial development and high degrees of economic freedom. However, the question remains whether the level of economic freedom contributes to profitability of banks. This study seeks to provide evidence on the impact of economic freedom on profitability of banks in Ghana, hence adding to the few empirical evidence in the economic freedom relationship, especially in the context of developing countries. The main contribution of the study is that it documents first-time evidence on the link between economic freedom and the profitability of banks in Ghana, with the researchers' knowledge. Another significant contribution of the study is that rather than using the aggregate or the composite index of economic freedom, the paper employs individual components of economic freedom to examine their impact on the level of profitability of banks. Let's look at the literature review. In the banking literature, the relationship between economic freedom and corporate profitability seems scarce, as I have stated earlier. Also, theoretical models and reality are yet to be established that will specifically examine the relationship between economic freedom and bank performance. For the two studies on the economic freedom performance relationship, bank performance relationship, Sofian and Habibullah, for example, in Malaysia, empirical revealed that economic freedom as a whole and business freedom, which is a subcomponent of economic freedom, have a positive influence on profitability of banks. Timo and Karabego established that changes in the level of economic freedom index positively affect equity returns in the Middle East and North African countries. In the European Union, Charteris itself found that a high degree of freedom, financial freedom gives a significant cost efficiency benefit to banks. Aziz and Knudsen, using the GMM technique, evidence that profitability of Arab banks is positively affected by a greater level of economic freedom. So looking at this literature, we can see that there are more to be done in terms of studies examining the relationship between economic freedom and profitability of banks, as few studies have examined this relationship. So we look at our methodology and the source of data. The study employs annual bank level data of 11 banks. It covers the period 2008 to 2017, obtained from the financial statement of the sample bank. And the economic freedom data is retrieved from the Heritage Foundation. The economic freedom indicators are scored from 0 to 100, where a higher value denotes greater freedom, and data availability informs the choice of the sample banks and the period as well. So we look at our variables, what constitute our performance measure. We measure in this study, we use bank performance is measured by several factors. So, for instance, the return on equity, return on asset, net interest margin, and return on investment. And in this study, we employ return on equity as a measure of bank profitability, which is the ratio of net income to shareholders' equity. We also have our independent variables. As I said earlier, instead of using an economic freedom measure or an aggregate or an index of economic freedom, we seek to examine how the subcomponents of the economic freedom variables affect the profitability of banks. So we employ financial freedom, business freedom, investment freedom, and fiscal freedom as our freedom measures to examine their impact on the profitability of banks. We also control for the effect of bank size and capital adequacy. So we look at what financial freedom means. Financial freedom measures the efficiency of the banking sector and how banks operate independently from government control and interferences. It means that with economic and financial freedom, banks are allowed to carry out their activities freely without unnecessary interference by the government. And we also look at business freedom, which gauges the freedom to establish a business and ease of obtaining a license to operate or close a business. And we also have investment freedom, which measures how investment capital moves without constraints between countries. We have fiscal freedom, which measures the tax burden government imposes on firms, and bank performance, which is the natural logarithm of total assets to bank, natural logarithm of total assets, and capital adequacy, which is the ratio of banks' equity, banks' total equity to total asset, and it gauges or it measures capital strength of banks. So these two variables, bank size and capital adequacy, it serves as control factors in the study. Whereas financial freedom, business freedom, investment, and physical are our main independent or explanatory factors, which we seek to establish their impacts on profitability. We look at the model specification, and likewise, this study also takes a panel approach. And the panel model is generally specified as this, and to examine the impact of the economic freedom indicators and the control factors on bank performance. The model is very expanded as this, where ROI is our independent dependent factor, and we have our independent variables as well as our control factors, and there is the L10. In this study, the fixed and random effects techniques are applied estimation techniques. These techniques take into account the group and time effects of panel data, which are overlooked in the ordinary least squares estimate, which is also a traditional measure. The study carries out, so to choose between the fixed effects and the random effects to base our results on, the study carries out the Houseman test to choose a suitable technique, as I said. So we move on to our analysis, or we present our results based on the estimation of these techniques. So from this, we have the pooled OLS estimates, the random effects estimates, and the fixed effects estimates. So based on these estimates, as I said, between the random effects and the fixed effects, we first of all, between these three methods, we first of all look at the random effects and the fixed effects to see if the Houseman test is significant or is insignificant. So if it's significant, it means that the fixed effects model is preferred and the results will be based on the fixed effects analysis. So based on our diagnostics, we realize that the Houseman test is significant at 1% level, meaning that the fixed effects the fixed effects estimates is the best model for our analysis. Therefore, the assumptions underlying the random effects and the pooled OLS estimates are ignored. So we base our analysis on the fixed effects. So from the fixed, as I said, we base our analysis on the fixed effects estimation. So from the fixed effects estimation, financial freedom shows a negative significant impact on bank performance. And this suggests that minimal interferences by government in the banking sector activities reduce banks' profitability. The result reflects the fact that government excessively intervenes in banks' activities in Ghana and exerts some control over the central bank in the quest of achieving an efficient banking sector. The effect of business freedom on bank performance is positive, though statistically insignificant. This suggests that greater licensing ability for starting, operating, and closing businesses also enhance bank profitability in Ghana. With the ease of obtaining a license, firms are able to avoid unnecessary costs, which improve their operations. And surprisingly, fiscal freedom, which measures the tax burden government imposes on firms, has a positive effect on bank performance, which we, in reality or rationally, is expected that tax burden should reduce the profitability of firms, because as they earn more, high taxes can take on the profitability of these banks. And the impact, however, is insignificant. So the coefficient of investment freedom, which shows how capital moves between countries, shows a positive and statistical significant impact on profitability. This implies that reducing restrictions to investment capital flows, allowing more transfers and payments, and providing access to global financial markets are imperative for enhancing the performance of banks in Ghana. The positive effects could be attributed to the large number of banks operating in the country as a result of lower restrictions on foreign banks' entry. And this increases competition among banks, which impacts positively on the efficiency of the banking system in general. And regarding our control factors, we realize that bank size has a negative significant impact on profitability. This may be an indication of the fact that the sample banks are small in size, who possess large market power in the provision of banking services. Capital adequacy also shows a positive, though insignificant, effect on the profitability of banks. So these are the findings based on the fixed effects estimation from the model. Now, we conclude and make policy recommendations based on the findings. As we said, as we have realized, the study documents that business freedom, investment freedom, and physical freedom positively influence bank performance, while the effect of financial freedom is negative. However, only investment freedom and financial freedom from our economic freedom indicators are statistically significant, implying that they are the key economic freedom indicators explaining the performance of banks in Ghana. The findings present important policy implications. The results suggest that giving banks the freedom to operate with proper regulatory mechanisms and relaxing constraints for investment capital flows are very essential for banks' profitability in Ghana. As we know, for further research, economic freedom research is only in the early stages, as we have seen in the literature review. Just few studies have examined the impact of economic freedom on profitability of banks. So therefore, much needs to be explored. And the study therefore recommends that aside from these economic freedom variables, which we include in this paper, other freedom indicators such as trade freedom, corruption freedom, and monetary freedom, which we have not examined, can be considered in future research. This can be done in the context of panel studies which involve different countries, or let's say a number of developing countries or developed countries, or a combination of these countries, such as an employee. Aside using these panel techniques, further studies can also consider the generalized method of movements, which can take into account any indigeneity problem inherent in this our fixed effects model. Thank you.
Okay, thank you very much, Ibrahim. You completed your second presentation as well, and Do you have any questions? I asked to all participants. Or
Can I ask a question?
Yes, you can
please,
ask a
yes.
question.
Congratulations, it's very attractive for me. But the main problem for Turkish academician, as you know, we cannot receive data terminals. We don't have Bloomberg, we don't have data stream or other important terminals. They are not in our universities libraries. So I want to ask you, how did you get this information, get this data? Maybe you can help me for other researchers. Maybe
Yes,
you
as
find another important data terminal
yes,
for us.
this one is purely based on Ghana, and it has taken so much of my time to collect this data from. I took my time with formulas, calculators to extract this data from the financial statements of these banks. So it's not really from a centralized database system. So this one, I took so much time to take the data, to make calculations, and to take off this data from these banks.
Thank
So
you.
this is how I got the data.
Thank you.
You're welcome.
If there is no other question, I'll move to the last presentation. Presenter is here. Welcome, Lokman.
Thank you.
Okay,
I apologize to everyone for being late.
no problem. You're just in time. Okay, go on then.
Can I share screen?
Yes, please.
I hope it is working now and you can see the screen, the presentation.
We can see it,
Yes.
no problem.
Okay, thank you. So my research involves the disclosure of use of proceeds in Turkish initial public offerings. The data starts from 2010 and it lasts up to 2019. This period covers the population of initial public offerings, excluding the 4 IPOs in 2020. So there are 129 IPOs, initial public offerings, during this time. And in this sample, we are using...
Excuse me to interrupt, Lokman.
Yes.
Can you make this full screen, please?
Okay.
Thank you.
Okay, in this period, there are 128 IPOs, and we are using 110 of all firms. And the reason we eliminate and drop the 19 firms in this period is these firms issue secondary equity, and they have to be issuing primary equity from which the proceeds can go to the company operations. Because the secondary equity issues only benefit the shareholders, incumbent shareholders, and proceeds are not used in the operations of companies, we drop these 19 firms. So this is going to be the first study in Turkey about use of proceeds section. This is one of the sections in the IPO proceeds that managers can exercise their discretion over the disclosure. And the other sections are the valuation section, the risk factors section, etc. So in this study, we consider 2 of these sections, valuation and use of proceeds. And prior studies in this topic are from the US, Hong Kong, and from the UK. So this is quite limited, and probably this will be the first emerging market study on use of proceeds disclosure. So the motivation is basically this one, and being the first, and this is also the first study to consider the valuation dimension and disclosure dimensions together. So this, we hope, is going to provide a contribution to the literature. We are trying to show that the motivations for going public are related to the valuation of the IPO. So basically, we are mostly interested in the investment motivation, whether the company is going public, do so to invest the proceeds. And this is hypothesized to provide better returns and also better valuations. By better valuation, we mean two things. The first one is discount. The second one is the valuation bias. So most IPO theories state insiders going public offer a certain price discount to investors to attract them, for retail investors, for institutional investors, etc. But most countries have no means to directly measure this discount. In Turkey and in several few countries, we can measure this discount because it is in the prospectus. It is stated explicitly in the prospectus, so we can measure it. So we are going to use this to show that the investment motivation results in less discount. We are proposing this because the prior research shows that the more valuation is biased, the larger companies offer discounts. So the discount is basically it's like an advertising practice, and the discount does not always mean a proportionate increase in the value after the company goes public. So we hope the investment intention will result in less discount and less valuation bias. And after going public, we hope that these intentions and better disclosure will result in larger returns in the short term and in the long term. So the IPOs, prior to going public, they have almost no information in the market. So by issuing prospectus, they inform the market, investors, and other parties in the transaction. And one of the motivations is to signal quality by using their discretion. So insiders have powers to determine what kind of information to disclose. Although some of the disclosure is regulated, still they have discretion over which information to reveal and which information to withhold. So we are thinking the greater disclosure signals the company quality. This is one of the underlying theories. And actually the literature supports this. And there is one study which is the basis of this research. It is Hill 2008. It is using a UK sample, and it shows the valuation multiples are simultaneously related to investment motivation. The difference of our research from this study is we are not using valuation multiples based on the IPO price, but we are using the valuation in the prospectus, which is the valuation before going public, not at the time going public. So this is before the company applies discount, and in this way, we can also directly measure the discount, which forms the basis of most IPO theories. So let me introduce you to what kind of motivations the companies present in the use of proceeds section. There are 3, 4, or 5 categories in the literature. We are using the 3-layered scheme in the literature, and these are investment motivation, debt payment or deleveraging motivation, or general corporate purpose motivation, which is a vague term for unspecific or vague purposes, motivations. So among these 3, we are thinking and hypothesizing that investment motivation will be most likely to signal quality. And we are basing our research on this foundation. So I will show you several examples of how we determine this, how we calculate these percentages. The first example considers the Pegasus company, which is one of the largest airlines in Turkey. The Pegasus disclosure is not very specific. You can see their expression in this prospectus here. I translated it into English. And the terms they are using are by no means specific. They are simply throwing the words around and without specifying any amount of proceeds and where they are going to. So we say this is zero specificity, zero investment, zero purpose, whatever. All of them are zero. Ambiguous disclosure. So the second example is a smaller company, Bakanlar Media, and this company is partially specific, and we determine, based on calculations, we determine that investment allocation will be 21% of all proceeds, and the debt motivation and general corporate purpose motivation is not specified. The third example is Çamaşır'20, a company, and this has 55% specificity. So they explain 55% of proceeds and where they are going to be used for. And all of these specification involves the investment intention. And they don't talk about the debt payment intention or other purposes. And the last company is Berkosan, and they provide full specificity, and out of which 45% is investment intention, 25% of proceeds will be used for debt payments, and 30% will be used for other purposes. So here are the hypotheses. I make these calculations for 110 companies. I can't present all of them. These hypotheses related to first H1A, H1B, they are related to valuation and use of proceeds relationship. The H2, A and B, related to use of proceeds and aftermarket return. And the last hypothesis relates to capital expenditures and research and development intentions. And we hypothesize that they are related to better aftermarket returns. This was proposed by a referee. So we are decomposing investment motivation into its parts. It has basic two parts: capital expenditure motivation and research and development motivation. So the first hypothesis will be tested by standard OLS regression, also Heckman selection regression, and two-stage least squares regression, which we propose a simultaneous relationship between discounts, valuation, and use of proceeds. The second hypothesis also will be tested by standard OLS and two-stage least squares. And the last hypothesis follows a similar structure. We will use standard OLS and simultaneous regression. The issue with simultaneous regressions is it is hard to find valid instruments in the instrumental variable regressions. So we had experimented with a lot of models, but our instruments were weak. So at the moment, we are trying to change the models and find more valid instruments to incorporate into models. So basically, we collect data manually from a public disclosure platform in Turkish, Kamu Aydınlatma Platformu. So we download prospectuses, collect the information manually. This data collection spans 3 years. And this is the last paper coming out of this data set. Basically, it spans 10 years. It from the last crisis to current crisis. This includes all IPOs in this period. The share price data is from investing.com, and Borsa Istanbul Stock Exchange. So this table shows the descriptive statistics for use of proceeds intentions. In the first column, we show the number of companies going public in each year. And the next columns, we show the number of intentions, corresponding intentions. As you can see, the specific disclosure is involves 92 companies, which is 84% of the sample. So most of the companies partially or fully disclose whether and how they are going to use the proceeds. And the investment motivation is the primary motivation for them. 72 companies, or 65% of all companies, state investment as motivation for going public. 52 companies, or 42% of them, state general purpose, and 39 or 35% of all companies state debt reduction motivation for going public. So on the right side, we are showing the intentions by amounts in dollar amounts. Again, the 4,251 million is the total amount of proceeds collected, and out of 4.2 billion, $3.2 billion is explained. They explain 76% of all proceeds and how to use them. The investment, the percentage investment is 46%. So 46% of all proceeds are used for investment. And the debt payment and corporate purpose, they are considerably smaller. So we consider in Turkey, the investment motivation is the primary motivation for going public. In Hong Kong, for example, investment is still the primary motivation. However, if you go to the UK, you will see that debt payment is the primary motivation. So these are the models currently, but these are going to change.
Lokman, sorry to interrupt. Can you summarize your last sayings, because we have out of time, in fact.
Okay.
I add a couple of minutes to you, okay?
Okay, thank you. These are the models for disclosure and returns, and I estimate them by probit, OLS, and simultaneous regressions. This is the initial results for first hypothesis. We can see that valuation variables are significant and minus significant. So this means an inverse relationship between valuation and disclosure. And this table shows the two SLS regressions and aftermarket and return regressions. So again, we can see the disclosure variables are significant. However, investment variables are more strongly significant than specificity models. So this table shows the long-term returns and capital expenditures and research and development expenses. The capital expenditures are significant in the short term, but not in the long term. The research and development expenses intention is significant both in the short and long term. So this points to the long-term nature of research and development and the long-term nature. And we classified the sample by Tobin's Q to explain whether the long-term returns are due to growth options, and Tobin's Q stands for growth options, and we find again significant differences for research and development. So this means research and development expenses are the yield results in the long term better. So the conclusion is that the investment is related to better valuation, less bias, and better aftermarket returns. Specificity is less strong, and the paper can be extended by incorporating long-term performance and long-term operating performance. However, this paper is still developing, so we are going to submit another major revision in 2 weeks. So this is not the final models and final results. Thank you very much.
Okay, thank you, Lokman. at 1 p.m. the next session will start. So if you have questions, you can ask quickly, or you can contact with presenters in email or with other ways. So I'm just waiting a couple of minutes to see whether you have any questions from participants. Also, while you are considering, I would like to share Professor Nalan Akdoğan's contribution that the sustainability reporting is getting importance, and in Turkey 52 firms are using and preparing these reports. She also thanks to this conference, and she likes all presentations, etc. Okay, any questions or contributions anymore? I guess nobody asks any questions. So thank you for joining, and see you next session then.
Yasemin Hocam.
Buyurun hocam.
Yasemin Hocam, thank you. It was the only session of our Congress which was held in English. I like to thank Track Chair Yasemin Köse for her concerning management, participants, all participants, and especially presenters for their insightful presentations. We will be very happy to see you in our next track. Best wishes.
Okay.
So.
Thank you. See you then.